The COVID-19 pandemic, which began in late 2019, triggered a global economic crisis of unprecedented scale. As countries around the world imposed lockdowns and restrictions to curb the spread of the virus, economic activities came to a standstill. This sudden halt in business operations led to severe declines in GDP across many nations, accompanied by a surge in unemployment rates. The crisis exposed vulnerabilities in global supply chains, disrupted trade, and highlighted the need for resilient economic systems. Detailed analysis of the economic impact. The global economic crisis of 2020 was characterized by several critical factors: severe contraction in economic activity. The pandemic led to widespread shutdowns of businesses and industries, resulting in a sharp decline in economic output. Major sectors such as tourism, hospitality, and retail were particularly hard hit due to travel restrictions and social distancing measures. According to the International Monetary Fund, IMF, the global economy contracted by approximately 3.5% in 2020, marking one of the deepest recessions since the Great Depression of the 1930s. Unprecedented unemployment rates. As businesses closed or scaled back operations, millions of workers around the world lost their jobs. The unemployment rate soared, with many individuals facing financial hardship. Governments responded with various unemployment benefits and support programs to provide temporary relief, but the scale of the job losses highlighted the fragility of labor markets. Disruption of global supply chains. The pandemic disrupted global supply chains, affecting the production and distribution of goods. Lockdowns and travel restrictions led to delays in shipping and shortages of critical materials, such as medical supplies and electronics. This disruption not only impacted manufacturing industries, but also led to higher prices and inflation in some regions. Government and central bank interventions. In response to the economic downturn, governments and central banks around the world implemented substantial fiscal and monetary measures. Stimulus packages, interest rate cuts, and quantitative easing were employed to support economies and stabilize financial markets. For instance, the U.S. government passed several relief bills, including the CARES Act, which provided direct financial assistance to individuals and businesses. Impact on small and medium enterprises. SMEs, small and medium-sized enterprises, which form the backbone of many economies, were disproportionately affected by the pandemic. These businesses often lacked the financial reserves and resources to weather prolonged periods of inactivity. Many SMEs faced closures or struggled to stay afloat, leading to significant losses and economic disruptions at the local level. Acceleration of digital transformation. The pandemic accelerated the adoption of digital technologies as businesses and individuals adapted to remote work, online shopping, and virtual communication. While this shift helped some companies thrive, it also highlighted the digital divide and disparities in access to technology and internet connectivity. Long-term economic uncertainty. The full extent of the pandemic's long-term economic impact remains uncertain.